Today, we're going to talk about analysis of investment portfolio. I'm not talking about investments as in investments in stock. I'm not talking about investments as in buying other companies, but I'm talking about investments that companies make in their own company. You, an executive in the company, make investments in your company, such as investments in creating new products, investments in creating new services, investments in acquiring new clients. These are investments you make that in the future will provide a return for the investment you made. I'm going to talk about how do you analyze that investment. What I'm going to talk about is not how much investment you should make, but rather what is the risk involved in making that investment, and is my portfolio of investment adequately diversified in terms of risk. Now, to give credit, the idea really came from some work of Stephen Wheelwright and Kim Clark, who wrote a book on product development. So I've taken that and modified that to a much larger scenario of investments in companies. So when you make an investment, you spend a certain amount of money to create a new product or create a new capability or acquire a new client, and that money that you spent doesn't provide a return until eventually, when you have the new product, new service, or the new client, you have new revenue, which then provides a return on the investment you had made. So let's look at the investment as how much market opportunity is there in this investment, and how much risk is there in this investment. The market opportunity might be the sum total of the revenue or the gross margin you might get from that investment over some period of time. So the larger the market opportunity, the larger the gross margin you would get over some period of time, the higher you would plot this investment on the vertical axis. Risk, while you could quantify it, it's probably adequate to simply leave it somewhat qualified rather than quantified. So you might have low levels of risk, medium levels, or high levels of risk, and you make an estimate of the how risky an investment is. And then you plot on this graph the investment based on the size of the market opportunity and the level of risk. But you don't plot a point. You plot by drawing a circle where the size of the circle represents the size of the investment you have to make to realize that market opportunity. And the size of the investment you make is the size of the circle, the height is the level of market opportunity, the horizontal axis is the level of risk. So what this says is, for about a medium level of risk, there's a pretty good market opportunity for that much investment. Now, ask yourself, what are some circles you would like, and what are some circles you would want to avoid? For example, you probably do not want a very large circle sitting here, where there is a high risk, low market opportunity, and have a large circle meaning a huge investment. Now, who would want to do that? Clearly, that is not an investment you'd want to make. What would be ideal is if you could have a small circle sitting up here, where you make a very small investment, great market opportunity, and very low level of risk. Well, but reality will tell you that's probably unlikely too. Even though you'd like it, it's unlikely to find it. What you're going to find, by and large, is that you want them to be flowing in this diagonal. The more the risk, the higher the market opportunity. So what you do is, you take all the investments you're making. So look at all the investments you're making in the company in terms of new products and new services and new client acquisitions and so on, and draw circles for each of those investments. And ask yourself, does this flow of bubbles, does that make sense for me? By analyzing this, you might find that you have too much concentrated up here. You have a lot of little circles here and not inner circles to the left. This bubble chart gives you a pictorial representation of understanding how diversified is your risk and are you reasonably balanced in terms of the risk you're taking and the market opportunity you're realizing. This is always a difficult thing to do, mainly because the risk is often judged, not quantified, and the market opportunity is often a prediction of the future. But nevertheless, if you spend the time understanding the market opportunity and the risk, drawing this bubble chart at a minimum tells you where are your investments going. What you'll also find is that there is a lot of money being spent on no investment at all, on just running the business. What this bubble chart mechanism, analysis of investment portfolio, does for you is forces you to focus your investments on those opportunities that are best for the company. This is discipline for making sure that your investment portfolio is diversified. Make sure you analyze the diversification of your investment portfolio.